Welcome to this FinBot Insights Explainer. Today we're conducting a sharp, evidence-based investigation into a piece of enduring market folklore, the so-called Santa Claus Rally. You know, Mark Twain famously quipped that pretty much every month is a dangerous time to speculate, and yet, for decades, one particular seasonal pattern seemed to defy that very wisdom. So, we are going to approach this topic like a proper financial investigation. We'll start with the legend, then dig into the numbers, explore the theories behind it, and most importantly, see if this anomaly still holds up. Then, we will deliver our final verdict. All right, let's begin by unpacking the legend itself. We're talking about a tantalizing, seemingly predictable pattern in what is supposed to be an otherwise unpredictable system. The subject of our investigation is, of course, the Santa Claus Rally. Now, this isn't just a vague feeling of holiday cheer, it's a specific and historically documented 7-day period of unusual market strength. Okay, let's move on to the historical case file. It's time to inspect the hard data that gave this legend its considerable power for so many years. Get this, since 1950, the S&P 500 has finished with positive returns during this specific 7-day period a remarkable 79% of the time. That is a pretty stunning track record. And we're not just talking about it being barely positive. The average gain for the S&P 500 during this rally period has been approximately 1.3%. Now, that 1.3% might not sound like a huge number, but this is where it becomes statistically significant. To put that into perspective, the average return for any other random 7-day period throughout the year is substantially lower. You can see why this legend has been so compelling for so long. So, if this phenomenon was real, what was causing it? It is time to interrogate the lineup of potential suspects, the proposed causes for this strange market anomaly. The theories really run the gamut. On one hand, you have simple holiday optimism, where more bullish retail investors are active. On the other, you've got more technical factors, like the completion of tax loss selling for the year and institutional portfolio adjustments known as window dressing. Okay, the historical evidence is compelling, you have to admit. However, the crucial question for us today is this: does this pattern remain a reliable tool for the modern investor? We have to ask the critical question: in the 21st century, has this trail gone completely cold? Well, the data reveals a truly dramatic reversal. Those strong positive January returns, which were historically linked to the rally, have all but disappeared in the 21st century. In fact, the average January return for large-cap stocks during this more recent period wasn't just flat, it was actually negative. The effect did not just weaken, it completely inverted. So, what happened? This disappearance is really a classic case of market efficiency at work. Once the anomaly was widely published, sophisticated traders with advanced tools simply arbitraged the pattern away. The game, as they say, was up. This brings us to the final part of our investigation. It is time to deliver a conclusion, a verdict based on the evidence, for you, the retail income investor. Yale Hirsch, the man who first identified the Avil Rally, famously suggested that a failed rally was a bearish omen for the coming year. This was once a core part of the legend. However, this predictive link has also completely broken down. The 2024 market is a perfect exhibit, delivering a powerful annual gain despite a failed Santa Claus rally right at the start. That old saying just does not hold water anymore. And this all brings us to a stark conclusion from respected finance researchers. Chasing these kinds of short-term, unreliable anomalies is a dangerous strategy. So the crucial point is this: the final verdict is that the Santa Claus Rally is now a historical curiosity, not an actionable strategy. For the modern investor, the focus should remain on a disciplined, diversified, long-term plan. Please remember, this explainer is for informational purposes only, and it absolutely does not constitute financial advice. Do not trust us or any other social media influencer for financial guidance. Always perform your own due diligence. If you found this investigation valuable, please do like this video and subscribe to FinBot Insights.